help you pick the right stock at the right time.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah. You're watching Indian Open. Let's go straight to the headlines. ICICI Bank MD and CEO Chanda Kochar goes on extended leave till the internal investigations are over. Sandeep Bakhshi takes over as Chief Operating Officer. Asian markets are bearing the brunt of heightened tension between the US and China on trade. Most indices start off lower. Kraft Heinz is looking to sell the Complan brand in India. That is a Bloomberg exclusive. And the Bharat-22 ETF's second tranche opens today, with the government looking to garner around 8,400 crore rupees. Well, let's take a brief look at the trade setup for the day. The global update first. The increased salvos between all parties involved is leading to some bit of tumultuous times for the markets. Look at what's happened. Trump has hit back at China with threat on new tariffs worth $200 billion worth of goods. Well, what did he expect? That China won't retaliate? Obviously, China did retaliate. And now Trump has gone ahead and given a further retaliation. So that has roiled, and this time I'm using the term roil, the world markets, because the global markets ended on a lower note in trade yesterday, marginally lower, but Asia has picked off the carnage, if I can use that term. 1% off for Nikkei, Hang Seng down about 2%, Shanghai down about 1.7%. The SGX 50 is not bereft of those losses. Remember, we did very well yesterday for the markets, for the benchmark indices, for most part of the trading day today, yesterday, with the upsides that we saw and the ending being flat. But in today's session, the SGX Nifty indicating that we might have a bit of a downside. The good part, though, is that crude continues to correct, marginally off yesterday, but continues to correct on hopes that the OPEC output would rise. The decision would be taken at the OPEC meeting, and that is something that is keeping the energy markets a bit subdued, which only augurs well for our markets. So where does that leave us? Well, remember, yesterday it was a flat day, as I said, but the market breadth was very, very disappointing. The broader markets corrected, albeit on fairly low volumes. The BSE mid cap or the NSE mid cap, BSE small cap indices down about 0.5%, 0.75%. But volumes were very, very low. The cash market volumes were to the tune of 23,000 crores on the NSE. On the BSE, about 2,000 crores. So the volumes were looking very, very low. The pain point, though, was that financials were looking wobbly in trade yesterday. If you just look at the contributors list, just want to show what the financials were doing in trade yesterday. If you just look at the contribution list, ICICI Bank was the lone ranger, which was contributing about 17 points to the upside. But look at the right-hand side of the page. Kotak Bank, HDFC Bank, HDFC, financials really came off in trade yesterday. They are looking wobbly. Let's wait and watch if they can contribute or to some bit of stability today, or will they continue to slide lower. The max OI for the June series has now shifted to the 10,700 put. The 11,000 call remains steady and the OI was up, but the 10,700 put is now where we're seeing the max OI. So the range has just become even more tighter in the last couple of days. In light of all of these, what are the stocks to watch? Needless to say, ICICI Bank would be one. Chanda Kochar goes on leave. Sandeep Bakhshi is the interim CEO, and we'll have a detailed chat with experts on this as well as to what it is do fundamentally for the bank. Sentimentally, I think we all know what's happened. Yesterday, the markets have kind of starting to price in or already priced in this move. Let's wait and watch if there's a further reaction today. A couple of other smaller names really. Goa Carbon, they're saying that the operations at the Paradeep unit temporarily halted due to labor issue. Centrum Capital and City Cable are a couple of stocks in which there has been some promoter action. In Centrum Capital, the promoter has bought in about 51,000 shares as well. Let's wait and watch. So some of these smaller names would react. We'll of course watch out for all the oil marketing companies and the way they behaved yesterday. Can we have some further upticks out there? That is something that we should be watching out for as well. However, let's try and tell you what's lined up on First Word today. It's the collection of the top editorial stories that we believe we should bring to you first up on the show. Is it the end of the Chanda Kochar era at ICICI Bank? And what does it mean for the lenders? Aswata Koha of Fitch Ratings joins in with his views. Higher raw material prices may take out the wind out of robust volumes growth for the FMCG companies. Will that happen? Agam Vakil will weigh in on that. And the second tranche of the Bharat-22 ETF opens today. What do investors stand to get from the offer? Well, that's interesting, and we'll watch out for that, and whether or not the recent history has helped investors there. And speaking of recent history, does recent history favor an Air India IPO? Maybe, maybe not. We'll try and talk about that as well. But let's start off with the top story, and that is ICICI Bank. The chief, Challa Kochhar, will be on extended leave until the independent investigation against her is completed. Meanwhile, head of the life insurance arm, Sandeep Bakhshi, has been appointed COO for 5 years. In Kochhar's absence, Bakhshi will be in charge at ICICI Bank. First, let's hear out this report from Vishwanath Nair.
The ICICI Bank board has appointed Sandeep Bakhshi, the current MD and CEO of ICICI Prudential Life, as the Chief Operating Officer of ICICI Bank. Now, this appointment is for a period of 5 years, according to a statement that the bank's board put out on the stock exchanges earlier on Monday. According to the statement, of course, Challa Kochhar will continue as the MD and CEO of the bank, as opposed to a lot of media reports which had suggested that she will step down as the CEO and that Bakhshi will be appointed as an interim CEO for the bank. Challa Kochhar, of course, will remain on leave for the duration of an independent inquiry that has been initiated against her by the bank's board. This independent inquiry is being conducted by a team that will be chosen by Justice B.N. Srikrishna, a retired Supreme Court judge. He was appointed by the board after the board received some tip from an anonymous whistleblower suggesting some alleged impropriety on the part of the MD and CEO of the bank. B.N. Srikrishna and his team will investigate these alleged improprieties and will also look at call as well as email records to determine what exactly went wrong. Sandeep Bakhshi, prior to this, was the MD and CEO of the life insurance arm of the bank. He took over that position in 2010, and before that he was Deputy Managing Director at ICICI Bank. Now, in his role, he will be handling all the businesses. He's in his role as a Chief Operating Officer. He will be handling all the businesses and the corporate center functions of the bank, and all the executive directors of the bank who are there on the board will be reporting to Sandeep Bakhshi. In the absence of Challa Kochhar, that is for the duration of this entire investigation against her, Sandeep Bakhshi will be reporting to the bank's board. But once she comes back as the MD and CEO, Sandeep Bakhshi will continue to report to Challa Kochhar. Of course, his appointment is still subject to some regulatory and some other kind of approvals that are pending at this point in time. But as soon as those come in, he will be taking over his role as the Chief Operating Officer.
Well, thanks a lot for that, Vishy. Now, you know, there are 2 or 3 questions, right? And we'll get in Saswata Guha to talk about those. But there are 2 or 3 questions that have been eased, if you will, as a result of this, right? One, has the board successfully managed to kill 2 birds with 1 stone? And which is something that we wrote about in the morning, which is that whether or not this has ensured smooth business continuity and addressed to an extent, at least in the minds of the investors, succession planning. Now, whether or not this will be the case or no, we don't know. As Vishy said, for now, what is known is that at some point of time, Challa Kochhar will come back once the inquiry is over and take over back. But a lot of people in the market seem to be believing that what will happen eventually is that Mr. Bakhshi will take over as the CEO from Challa Kochhar as well. But all of them is in the realms of possibilities, nothing that is given right now. But, well, it's a smooth thing that has been done, and maybe the markets have liked it as well. Let's find out if Saswata Guha has liked it or no. He's Director of Financial Institutions at Fitch Ratings. He joins us right now on the phone line from New Delhi. Saswata, good morning. Thanks so much for joining in. While this was widely anticipated, the fact that it has played out, what's your first reading into this?
Hi, good morning. I think certainly it's a move in the right direction. I would say that compared to the stance the bank has been taking in the past. Of course, I think what we also need to bear in mind is that some of these actions have come as a result of increased scrutiny. I think there was a second whistleblower complaint, and subsequent to which, obviously, regulators both in India and I believe abroad are looking at this issue a lot more closely. And I think the board, in its right frame, has obviously taken the decision it has taken. So from our scheme of things, we have recently affirmed the rating. Of course, from our point of view, we will obviously wait for the outcome of the investigations, the various investigations that are currently being undertaken at the bank. But until that outcome is out, I guess, it's a positive move.
You know, so a couple of people that I spoke to, Saswata, said that this effectively kills two birds with one stone. They've addressed issues relating to whatever you call it, corporate governance or business continuity, whatever you may, and it also takes care in the minds of people, if not actually succession planning as well at ICICI Bank. Would you read as much into this?
Well, I mean, I don't want to speculate in terms of what may happen, but if you had a chance to read our commentary, you know, particularly the one which we put out after this whole thing started gaining steam, I mean, we certainly weren't happy with the way the board managed the whole affair, and we pretty much said it in as many words. But clearly, I think at this stage, and as somebody who's looking at these things from the outside, what appears at this stage is sort of the board itself has sort of got itself into a kind of tangle, because their own position on this thing was on this issue was very different until some while back, and today we have a situation where clearly the MD is now on leave until the independent probe is over, and this gentleman who's now the CEO of the bank is still is going to report to the current MD who will be on leave. So really, from an operational perspective, I don't know if it necessarily changes anything. But yes, I guess we'll have to wait and see, you know, for you know, things to emerge in terms of really if indeed Mr. Bakhshi is likely to, you know, take the reins of the bank eventually. But at this stage, I don't want to speculate on that.
Yeah, but during the period of a leave, he'll be reporting to the board. In effect, for the foreseeable future, he reports to the board. Saswata, the other question that comes in, and I agree we shouldn't speculate, but Chanda Kocher's term comes to end in March 2019. Typically, these issues or these such of investigations, if you will, don't really happen in a period of 15-30 days, right? They take some time. So which is why I think my question was that whether or not this kind of takes care in the minds of people, the issue of succession planning. Nevertheless, I understand that you don't want to speculate on that. While this has probably happened to a lot of people's mind a bit too late, do you think this was arguably the best possible course of action that you, as somebody who's watching ICICI Bank, would have hoped for?
I think this was something that we would have, you know, we would have expected the board to do in the first place. Clearly, obviously, the board stance was slightly different. But as I said, I think given the kind of you know, increased scrutiny that the bank is undergoing from various corners, I think this was a logical move to take. Just coming back to your earlier question, well, I perhaps misunderstood the question, the way you had laid it. But you know, let's put it this way: at the end of the day, you know, leadership at banks need prior approval of the central bank. And given what's happening and what has happened in a couple of the other banks, and in light of the, you know, issues that this particular bank is facing, I would be very surprised if, you know, when that term comes up for renewal, the RBI goes all out and sort of gives an approval on that. But again, I don't want to sort of go all that far. But all I'm saying is that, you know, given what the past has been in a couple of the other banks, you know, we'll have to wait and see, because it's not going to be an open and shut case.
Okay. That's a fair point as well. And I agree, Saswata, we don't want to speculate right now at all. But thank you so much for joining this early in the morning and giving us your thoughts. Really appreciate it.
Thank you.
Well, that's Saswata Guha of Fitch Ratings. Mr. Bakhshi has been the Managing Director and CEO of ICICI Prudential Life Insurance, for the people who don't know, since 2010. Remember that, August 1, 2010, as I read. So a lot of experience in this retail space by virtue of the position that he already held. Maybe it's a win-win for all parties concerned. Let's wait and watch. The market endorsed this move because it was widely expected. Bloomberg News reported about this as well on the lunch show. So while this was widely expected, the fact that the stock did very well is something that the equity markets at least liked. Saswata Guha saying that they are fairly happy with the developments as well, something that they believe the board should have done in the first place. Anyways, for now, ICICI Bank remains in focus in news. We'll get to know at about 9 a.m. if there's a further reaction on the stock as well or no. Moving on, the second piece, cost pressures are on the rise for the FMCG companies as key inputs like wheat, sugar, copra are getting costlier. Just how much have they spiked and which companies stand to lose the most? Agam Vakil's joining in to tell us about that. Agam, ceteris paribus, other things remaining constant. What are the companies that will get impacted, and will the impact be seen in the April, May, June quarter itself?
Right, Neeraj, you know, in the fourth quarter, what we noticed was that a lot of these companies saw substantial advantages coming in on account of softer wheat and sugar prices. Case in point, Nestle and Britannia specifically, where they saw gross margin expansion. But over the last 2 months, what we're starting to see is hardening of prices. And wheat, especially when we see a little bit of an uptick there, as much as 1% on a month-to-month basis. Sugar has risen as much as 17% over the last 2 months, and that could be a, well, I think that's where there's a little bit of a change there. We need to, you know.
Yeah, the color is wrong,
yes,
but the arrows are correct. So let's go with that. Yeah.
So we have seen the 17% increase in the prices of sugar, and that could be a worrying factor, especially for a lot of these companies which are dealing with foods. And on the back of that, there could be some signs of decline in gross margins when it comes to companies like Britannia, or for that matter Nestle. Wheat, of course, has remained stable, but that could also see that uptick could also affect something like Jubilant FoodWorks. And moreover, don't forget, something like dairy prices have also been largely stable, but an uptick could affect, well, prices of cheese, thereby impacting Jubilant FoodWorks as well. But moving on, and when it comes to Copra specifically, now, you know, while Copra has seen that decline of, or rather led to the decline in gross margins for Marico, a lot of analysts are now of the opinion that Copra prices have peaked out. In fact, the management also says the Copra prices have peaked out. That said, we've still seen a little bit of an uptick on a month-to-month basis. So we're going to have to see how Marico behaves when it comes to some of these prices. This is as far as your agri-based commodities are concerned. Moving on to those which have exposure to crude. And again, when it comes to titanium dioxide, that's seen an uptick around 4% on month. Lab, that's, technically it's a linear alkyl benzene, which is used as a surfactant in a lot of your detergents and soaps. That's seen an uptick around 2.8% on a month-on-month basis. Palm oil, on the other hand, remains subdued. It's actually seen a decline. That's a positive for soap manufacturers, but it does counter the fact that we've seen an uptick in something like a titanium dioxide or lab. In polymer has seen a 6.3% uptick, and that does impact companies like HUL and Godrej Consumers. So on the whole, if I were to summarize this in terms of impact for a lot of these companies, I would put Britannia along with Nestle, HUL and Godrej Consumers to a certain extent, which could see some amount of margins pressure for this particular quarter, should we continue to see hardening of some of these key input prices.
Okay, so that's the whole sum and substance. If you had to, Agam, nail it down to that, I know you mentioned all of the companies, but if you had to nail it down to that one top company which has the maximum impact, likely maximum impact, right, which one would you watch out for?
I would say two. Britannia and Nestle both use sugar, and we have seen a substantial increase in sugar prices. It would be them. Considering we're also seeing an uptick in the wheat prices over the past couple of months.
Wow. Okay, let's wait and watch. Maybe companies can mitigate those costs by some internal cost controls, but purely, as we said, starting off the link, ceteris paribus, other things remaining constant, these are the companies that could get impacted. Agam Vakil, thanks for putting that into perspective. Lovely piece of analysis out there from Agam. Watch out for some of the FMCG names, and let's wait and see if they can mitigate the increase in raw material prices via some other means. In a bid to meet government's divestment target, ICICI Prudential Mutual Fund has put forth a further fund offer for Bharat-22 ETF. How much is on offer and at what price? Jayesh Khilnani has the details. Now, Jayesh, two pieces really. I want to know, one, of course, what's this fund all about, and what will somebody who's subscribing get? And two, what has somebody who's subscribed in the past ETFs gotten thus far? Is it a smart investment?
We'll get to both of them, Neeraj. First of all, this is the second tranche that Bharat-22 ETF is on offer, being managed by ICICI Prudential. So essentially, the anchor book opens today, June 19th, and tomorrow onwards till the end of June 22nd, it is open for subscription for the non-anchor investors. Now, this time around, something interesting that they have done is they have come up with a fund of fund as well. If we can go to the other slide. So that's only for the retail category. Now, Neeraj, this is interesting because in case for an an investor who does not have a demat account can subscribe to this as a mutual fund offer, which is open for subscription from today till June 22nd. So this is the change that has happened from the first tranche. The other change that has happened is this time around the discount is only 2.5% compared to the first tranche, or a discount of about 3% that we had. The offer size that is there is 6,000 crores with a green shoe of about 2,400 odd crores, of course with the approval of the government as well. Now if you look at the sector allocation that we have, industrials have the maximum, which is 22.6%, followed by financials 20.3%. You have utilities at about 20%, and you have energy at 17.5%, FMCG 15.2%. This is the interesting one, we'll get to that. And the lowest sector allocation is towards the basic material space at about 4.4%. Now if we move on to the top 10 stocks that we have per as the weightage, L&T is the top pick over there at 17.1%. Now FMCG, I was telling you that this is interesting is because ITC is pegged at about 15.2%, and this is the only FMCG stock that makes it to this list, followed by SBI Power Grid and Axis Bank. They will have a weightage of about 7.7 to about 8.6%. We have some more names like NTPC and ONGC, more than 5% weightage. And lastly, we have NALCO, IOC and BPCL, which have an equal weight of about 4.4% each. Now, if you look at some of the valuations that the market is pricing in, this is borrowed it from HDFC Securities. The FY20 earnings growth, what they are expecting is that for Bharat-22 it will be at about 22% versus the Sensex earnings estimate of about 19%. Based on that, the price to earnings comes out to be 14x and 15x for the Bharat-22 and the Sensex, and similarly the price to book is about 2.5x and about 2.3x for the Sensex. Now the dividend yield is the interesting one because these are PSU companies, so 2.5% dividend for the Bharat-22 index, while we have 1.1% dividend yield for the Sensex. Now to answer your second question, Neeraj, of how they have performed or how an investor who would have subscribed in the November tranche would have performed. So if you have a look at this chart, what this essentially shows is that the Sensex has in fact outperformed not only the Bharat-22 index but the ETF itself. So the Sensex from November, since the inception of this ETF, has given you an excess of about 5% return, while the Bharat-22 index and the Bharat-22 ETF have given you negative return. So the index itself has given you close to about 7 to 8% negative return, but the ETF has in fact outperformed the Bharat-22 index, but both of them have underperformed the Sensex index on the whole.
But anyways, it's too soon, maybe a time to judge what the performance would be. You usually invest in these instruments for a long term. Having said that, these are the returns for you, so you know what each of these indices have done so that you can take a call yourself. The last piece on First Word today is on government's failed attempts at finding a buyer for India, which has prompted the Finance Ministry to contemplate on an IPO, but recent history shows that the primary market has not been too kicked about public sector units. In fact, the last 5 government IPOs have been bailed out by public sector financial institutions like LIC. It may be different this time around, but Sumit Sarkar, who's put together all the data, Johnson now with the details. Sumit, it's definitely going to be an uphill task.
Yes, it could be, given the fact that Air India is not profitable and also has a huge debt on its book. Now, if you see the last 5 government IPOs that hit the primary market, Mishra Dhatu Nigam, Hindustan Aeronautics, Bharat Dynamics, New India Assurance and General Insurance Corporation. All these 5 companies' revenue grew at a compounded annual growth rate of 5 to 42% from FY13 to FY17. And on the net profit front, if you see, it grew at a CAGR of around 4 to 15%. Now, Hindustan Aeronautics here saw a fall of around 5%. Now, that is because of lower other income and higher tax expense in FY17. On the operational front also, if you see, all the companies were profitable. Now, if you see the return ratios for these 5 companies, now the return on equity and return on capital employed was in the range of around 8 to 22%. And the return on equity for Mishra Dhatu Nigam was 18%, HAL was around 21%, Bharat Dynamics 22%, New India Assurance and General Insurance Corp 8 and 18%, ROC was in the range of 8 to 22%. For Mishra Dhatu Nigam around 15%, HAL 10%, General Insurance Corporation 22%. Now, despite these factors, the subscription ratio for these 5 IPOs was only 1 times, and more importantly, these 5 companies raised close to around 26,472 crore rupees, and of that 26,000 crore, nearly 62% was funded by government companies. Now, Mishra Dhatu Nigam raised close to 438 crore rupees, of which 252 crore rupees was funded by government companies. And in this fund infusion, LIC played a major role. For Hindustan Aeronautics, out of 4,100, 2,844 crore rupees was provided by government companies. For Bharat Dynamics, out of 961, 175. For New India Assurance, out of 9,600, close to 7,400. And for General Insurance Corp, from 11,300, close to 5,641 crore rupees was funded by government companies in these IPOs.
Wow. So
that's 62% of the total amount raised by these 5 companies.
Why doesn't it surprise me, Sumit? But having said that, so you mentioned that it might be an uphill task because of the debt, etc., etc. So how do Air India's financials or the numbers shape up?
Now, if you see Air India's financials, the company's revenue, now this is the revenue of Air India and Air India Express, it has grown at a compounded annual growth rate of 9% over FY13 to FY17, right? From 17,800 crore rupees in FY13, it grew to around 25,100 crore rupees in FY17. On the operational and on the bottom line front, the company has been making losses. From FY13 to FY17, the company has been reporting net loss in the range of around 5,800 to 3,400 crore rupees. On the operational front, however, the company managed to turn profitable in the last 3 financial years. That is from FY15 to FY17. But again, we see a drop here in FY17 as compared to FY16. Now, on the balance sheet side, if you see, the company has a huge debt of around 48,000 crore rupees as of FY17, and the net worth of the company has been negative, and for FY17 it was close to 21,000 crore rupees. Now, if you see here, the debt number for Air India has come down a bit compared to the past. That is because of the fund infusions done by the government to repay the debt. That's the only reason why the debt has come down. Now, if you see, lastly, if you see, what are the factors that could be that could interest investors to bet on Air India's IPO? Firstly is that the 30% of the debt backed. Now, out of the 48,000, 30% is backed by its asset. That is the 86 owned and leased aircrafts of Air India. Secondly is the unabsorbed depreciation. That is close to around 32,000 crore rupees. Now, this unabsorbed depreciation means that whenever Air India gets profitable, and only if it gets profitable, the company will not have to pay any taxes. It can consume that unabsorbed depreciation of 32,000 crore rupees. And lastly, and the important one that could interest investors in Air India's IPO, that is the premium international and domestic slots that the company has, and which is hard to get by now. Now, it has around 4,000 domestic slots in 54 destinations and close to 2,800 international primetime slots in around 39 destinations. So this is the important asset that Air India has and which could interest investors.
But that could interest somebody who is more like an airline, right? I mean, why would an equity investor be interested in the kind of slots that that Air India would have?
Because other airlines don't have that kind of slots. So
in the hope that somebody else will come in at some point of time.
Exactly.
Okay. Interesting to put this into perspective. Sumit Sarkar, thanks so much for doing that. Remember, it's a standard disclaimer. What's happened in the past to other IPOs may not necessarily hold true for Air India, but this is our best case scenario of what Air India's financials are and what could happen to the IPO, proposed IPO, let me put it that way. That's all that we have on First Word today, but lots more lined up on the show. We talk about the now and here with Jinesh Gopani of Axis Mutual Funds. Their schemes have been amongst the best performing schemes. We'll try and find out what makes them tick. In what shape and size does RBL Bank see itself in 5 years' time? We decode the bank's vision 2020 with Executive Director Rajeev Ahuja. And CCL Products wants to take its coffee strong rather than light. Managing Director Challa Srishant will tell us more.
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार. Just working on my expansion plan.
Funding का चक्कर.
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. ला.
अरे.
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
Interesting. And what exactly is this bridge?
a stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल.
हाँ.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
One more opportunity to invest in ICICI Prudential Mutual Fund's Bharat-22 ETF and own jewels of corporate India. From 6 core sectors at a discount of 2.5%. The scheme seeks to give you growth, stability and create long-term wealth. Non-demat account holders can now invest in the new fund offer of ICICI Prudential Bharat-22 FOF. Hurry, invest in the scheme of your choice. Further fund offer and NFO closed 22nd June 2018. To invest, visit ICICIPruMF.com. Tarakki kare. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Welcome back. You're watching Indian Open. Well, we have weakness across Asian markets after we've had some more escalation with respect to war of words between Donald Trump and Xi Jinping. For now, as far as the Shanghai is concerned, that's down by as much as 2%, and Hang Seng also by the same quantum. Nikkei, on the other hand, looking at cuts of around 1%. What does it mean for the SGX Nifty? Well, 0.5% cut at around 10,735. But with that, let's go across to Navneet Saluja, who's standing by to give us an idea about what the futures and options market is throwing up in terms of cues. Navneet, good morning.
Hi Agam, good morning. Well, it will be very important to watch out for levels of 10,720 and 10,700 on the downside. Just to remind our viewers, 10,700 is the strike where maximum open interest is. So if that gets breached today, you'll probably see a lot of unwinding. But what happened yesterday? No major action seen for the futures and just 1% build up when it came to the open interest for Bank Nifty futures also, which continued to close at a discount of almost 23 points, 3% higher for open interest, telling you there were some mild short positions being taken for this one. Well, low volatility so far has been supporting this market, but yesterday we did see India VIX going up, but it's still at comfortable levels of about 12.3. In terms of put call ratio, that went lower because of higher call writing coming in. So Nifty PCR went to levels of 1.51. The Bank Nifty PCR saw some bit of increase to about levels of 0.81. Let's tell you then what happened in the option strikes of Nifty. There was a lot of call writing around the mark of 11,000, 10,900 as well as the 10,800, whereas on the put side some bit of addition was seen for 10,700 as well as the 10,600. Near term range, let me tell you, remains the same. It's between 10,700 to about 10,900, but if 10,700 gets breached today, probably there could be more downside which could be seen. In terms of institutions, there was more of unwinding of long positions that was seen by FIs. On the index futures, 4,000 contracts were unwound, and on the short side nearly 3,000 contracts were added. And similar is the picture when you look at the index option side. So this is the place where a lot of contracts were being added in the last few sessions, and finally some unwinding was seen on the put short side. Some stock futures to keep an eye on. Infibeam has entered into the F&O band, so watch out for this one. The other stocks to keep an eye on would be Bata India, which is inching very closer to its 52-week high mark. So let's see what happens today, but fresh longs were seen for this one. And all eyes will be on ICICI Bank, which was up yesterday. Some bit of short covering on the future side was seen for this counter. Back to you guys.
Well, we'll watch out for all of those. Navneet, thanks for putting that into perspective. So ICICI Bank was one mover, some footwear companies were other movers. Let's talk about all of those with Mayuresh Joshi, fund manager at Angel Broking. He joins us right now on the show. Mayuresh, good morning. Thanks so much for joining in. What's the thought here, Mayuresh? ICICI Bank remains the center point of focus, though we'll talk about OMCs, footwears and the others too. But what do you make of this development? And has the market in the last couple of days priced priced this move in already?
So morning, Neeraj. To a certain extent, I think the markets were sensing developments happening on this front. And to a large deal, I think, as the Sri Krishna probe will probably gain momentum, whatever the outcome, I think at least the overhang from a near-term perspective is away from the stock. On the other hand, I think any management change that probably comes through with a clean chit, I think with no excess package that is carried forward over the last few weeks in terms of the controversy surrounding the bank, I think that will give respite to not just investors but also the normal functioning of the bank. On the other hand, I think the fundamentals of the bank are improving and corporate lenders in general have cleaned up their balance sheets significantly. So for ICICI Bank in particular, if you look at their net stressed assets, which include the restructured book and the watch lists, it's at a mere 5.86% of the overall loan book. The retail advances are now 57%. You're probably looking at the retail fee income being 75% of the overall fee income growth. So to that bit, again, I think the core dynamics of the bank have obviously been better in terms of cleaning up. And again, I think valuations are far more supportive at this point of time, assuming the growth that retail advances in excess of 20% can actually give and deliver to the bank. So yes, from a near-term perspective, it's developed a very strong liability franchise. You've probably got the right levers in place. And these developments, I think, are probably in the right direction. So yes, I think the positive bias that we probably had with the bank still continues over the medium to long term.
Okay, Mayuresh, now let's talk about OMCs. We have seen a little bit of a surge there. Of course, changes in prices for petrol coming in through. How are you looking at something like an IOC, HPCL and BPCL now?
Morning, Aragam. So I think the two key variables for oil marketing companies obviously is how the moment of crude is and again how the moment of the rupee is against the dollar. Based on these two factors, the sensitivity to earnings is probably far more dependent. And to that bit, again, the kind of spurt that we saw in crude prices had a detrimental effect. To top that up, I think the issues and concerns surrounding marketing margins is something that also had a huge overhang on these stocks. But I think the ministry has come out. There have been clarifications that they're not going to probably tweak around in terms of the marketing margins for these companies. So I think the variable pricing dynamism that these companies exhibit can very well continue. On the pricing of crude, again, I think it's a large unknown variable at this point of time. But with OPEC expected to meet and the expectations of supply being increased, you're probably expecting to see oil prices cool down. And even if they stay within a broad range of 70 to 80, you probably have that penciled in from an FY 19-20 perspective as far as the assumptions for crude are concerned. Now, relating to trade wars, maybe the rupee depreciates even further. So to that bit, again, I think there might be an incremental EPS hit in terms of the first two quarters. Along with that, what you've probably seen in terms of the gross refining margins, the middle product cracks have remained extremely strong. So in my opinion, again, I think the GRM should be far more stable. So again, I think within the OMC pack, IOC is something that I'll still continue to prefer. Though I think the forward multiple on an EV/EBITDA basis, specifically for petchem and the marketing side of the business, will get lowered down because of these uncertainties. But I think refining EV/EBITDA should hold on. And largely, I think the marketing volume should hold on. And the Paradip utilization should probably have better earnings. So I think I'll be selective in OMCs, but IOC probably remains one of my top picks.
Okay, so it's IOC which is preferred in the OMC stack. That's the word coming in from Mayuresh Joshi. But there are plenty of other stocks that we need to keep an eye on the back of stocks and news. And of course, we also have some broking calls in ICICI Bank. So we have a research team joining us as usual. Good morning, guys. I'm going to start off with stocks and news. Nikki, what do we have in your list?
First one, you're starting with Goa Carbon, where the company has halted operation in his Paradip unit due to labor issue. We saw some reaction coming in on the counter, as much as down as 4% in the previous session of trade yesterday. Titan is the other one that we're tracking this morning. It has sold an entire stake in Titan Time Products to Denlord Technologies for a sum of around 19 crore, a small number that we're looking at. So the other one that we're tracking is Borosil Glasswork, where the company has approved a bonus issue in the ratio of 3:1. Also Glenmark Pharma, where US FDA has approved company's first supplement ANDA for the manufacturing facility that we have in North Carolina. Now, the company has already invested a sum of around $100 million in this facility, so might just see some reaction coming on that count. Axis Bank, where the search panel has set aside on BOB CEO PS Jayakumar, whose term comes to an end by the end of this year. Now, remember, this is a TOI exclusive. Also, in terms of bulk deals that we're tracking is City Network, where the promoter has offloaded 0.8% stake in the counter for a sum of around 11 odd crore. In terms of insider trading, we have the promoter of Everest Kento Cylinders, which has which has acquired 0.15% stake in the company.
All right, and we also have ICICI Bank, which is in focus. Shraddha, what do you have?
So Agam, overall, there's positive commentary coming in from brokerages. First, you have Jefferies on ICICI Bank. They have retained their buy with the target price unchanged at 380. They've said that they see the COO role as unnecessary in the long term, but for now it seems that the board has found a safe middle ground. They continue to remain bullish on ICICI Bank, given the operating environment is improving. There has been arrest in the fresh NPL formations and because of cheaper valuation. So this is the positive view aside of all of these negative news flow. They've also maintained a buy on ICICI Prudential with a target price of 520. IDFC Securities again maintained their outperform with the target price unchanged at 370. They have seen this as a win-win for both ICICI Bank as well as ICICI Prudential. They have said that they see Mr. Bakhshi as the de facto interim CEO itself. They believe he will take over as the CEO from Chanda Kochar later when her term expires in March 2019. They more importantly believe that Bakhshi will continue with the existing policies of the bank, and they believe that this will ensure smooth business continuity, and also that this appointment addresses concerns on succession planning. They have said that this is positive, so investors will now stop worrying about the succession planning issues, and now focus will turn back to earnings turnaround at the bank. Citi again retain a buy, target price of 390. They have also said that the appointment makes Mr. Sandeep Bakhshi the de facto CEO, and they believe this will reduce the uncertainty regarding management continuity. So again, the focus seems to be more on management continuity, and that the band will now shift from all of these issues back to earnings recovery. ICICI Bank shares, of course, ended about 3.5% higher on BSE yesterday. ADRs have closed nearly 5% higher. Right. So I suspect even in the markets which are looking weak, we could probably see a positive start at least.
Fair enough. Thanks, guys, for bringing us those details, and we'll be watching out for ICICI Bank as well. But Mayuresh, some may argue that given the fact that the Nifty may see some amount of correction, stocks like Bajaj Finance may fall further. At what point in time do you think it would be a good buy, or do you think that's a good buy even at this point in time? How would you deal with something like a Bajaj Finance or a Bajaj Finserv at this point in time?
So Argam, I think if you look at both these entities, I think they've exhibited very strong growth. And the testimony is in terms of what they have probably delivered over the past few quarters. So I think in tough times, they probably recalibrated their business strategy and what they probably innovated in terms of both their back-end digital upgradations and again the digital offerings on the front end. I think that's reaping them huge benefits. In terms of the consumer durable business for Bajaj Finance in particular, I think the kind of growth that we've probably seen with minimal pressure actually coming through on asset quality and very smartly moving out of the loan against property or the more riskier loans that they used to probably meet out. I think that strategy has paid them high dividends. Now, one might always argue that the valuations have been on the higher side, but for a qualitative franchise like this, the valuations have been at a premium, not just to the Sensex, but even for their own peer group. Now, when to enter, I think that's a very tricky question. But again, I think any decline in a staggered way probably can be a good opportunity to probably enter these stocks. Because I think the loan growth in excess of 30-odd%, the earnings in excess of 30-odd%, can very well continue over the next few quarters. As a caveat, you might see some amount of pressure in terms of cost of borrowings with yields moving up and the bank borrowing cost going up. But somewhere I think a pass-through will happen which will compensate and probably replenish the kind of fall that one really expects in their spreads. So yes, I think declines in a staggered way is something that I look at for Bajaj Finance.
What's the vision here though? Bajaj Finance, do you envisage that what it has done in the past 3 years can be reenacted in the next 3 years? I mean, it's virtually doubled, right? Though demon lows played a part out here too, but it's virtually doubled from where it was 2 years or 3 years ago. Can the same happen on an enhanced size 3 years out?
So Neeraj, again, I think a corollary can be drawn in terms of how HDFC Bank had grown. So in the past 10 years, or the first 7 years, I think it had grown in excess of 25-30% odd. Now, as the base increases, obviously you can't grow at 30% odd. So as you grow larger in size, the probable expectations of your earnings growth recalibrating a little bit lower than your average historical averages is a given. But what Bajaj Finance has done, and this is very, very interesting over the last 3-4 years I was mentioning, I think they've been innovating. And they've been innovating very, very positively, looking in sense as what technological changes have happened, looking in terms of the discretionary demand patterns and what the end consumer actually wants. So if you probably look at their cards that they introduced, I think it was a very innovative offering. And I'm pretty sure I think the management is on top of things as we understand in terms of probably getting innovation and technology to the customers. So I think the customers are not probably going to feel the brunt in terms of probably getting what they probably want, either in terms of financing or whatever they need to access at their fingertips. So I think it's a very innovative and a very proactive approach that the management has, and that's getting reflected in numbers. So the base might just come off a tad bit, but to even grow at this base in excess of 25-30% is a commendable thing, for which the valuations probably are probably on the higher side for Bajaj Finance.
Okay, well, it's time to bring in our technical experts for the day. We have Thakkar, Assistant Vice President for Equity Research from Anand, Rathi, as well as Hadrien, Mendonca, Senior Technical Analyst at IIFL, joining us as well. Thanks, guys, for joining us, and good morning. Jay, good morning to you. I'm starting off with your view on the benchmark indices. What is your approach going to be from here on?
Hi, good morning everyone. Well, I think the market is still sideways with a bit of negative bias as far as the index is concerned, because then what we have been seeing or we have been observing in this series as far as the technical as well as the derivative data is concerned is that on the upside 10,900 is proving a very stiff resistance, and we have been seeing good amount of writing at those levels, 10,900, 11,000 levels as well, and those levels are proving to be very crucial as far as this series is concerned. On the flip side, we have been seeing good amount of writing at the lower levels at around say 10,600, 10,500 levels as well. So I think more or less it's trading within this range, and since it has reversed from the upper end of the range, I think now it's likely to head towards the lower end of the range, at least for the short term, for a day or two. I mean, for today or till tomorrow, I think we can see the levels of almost 10,680. 650 on the lower side. On the upside, 10,840 will be the resistance. Hence, that's the call for today as far as the index is concerned. The Bank Nifty too has been seeing good amount of writing at the higher levels, 26,500, 26,700. This is acting as a very crucial resistance, and we have been seeing that in the series. We have been seeing good writing happening at those levels, and it's just not for the monthly series but for the weekly series as well. At those levels, we have been seeing good writing and resistance. So I think that 26,200, 26,000 levels can be seen on Bank Nifty as well for the short term, that is a day or two.
Okay. Hadrien, what is your approach today? The SGX Nifty is turning out to be a deceptive lead indicator, but what are the trends suggesting?
Yeah, so as as we all know that Nifty is actually consolidating and doing nothing. So we are grinding around this 10,800 levels, and the worrisome problem here is the Bank Nifty. So Bank Nifty is actually trading in a rising channel pattern, and right now it is at the lower end of the channel. Things can get a little more worrisome if Bank Nifty breaches below the 26,250, 26,200 levels. That is when things can get a little more scary for the banks, because then things can turn really weak, because we're going to see a breach of the rising channel that I'm talking about, which may not happen today, because ICICI Bank's gap opening that we are expecting because of the change in management. But that's something that we need to watch out for. 26,250 below that, things can get really bad in the short term.
Okay, so in light of that, what are the stocks that one should watch out for? We'll talk about those in just moments from now. Actually, it's just about 8:50. So time now to get in our special segment, Bloomberg Edge, going before we get in stock-specific recommendations from both Hadrien as well as Thakkar. Jayesh Khilani should joining us in moments from now to talk about the pattern that the Bloomberg terminal has thrown up. Keep in mind, it will not be just about a stock. It could well be about an index. It could well be about an asset class on which an actionable trade could be taken by viewers who are watching this piece of segment. Okay, while we just wait for that to happen, maybe get in those stock recommendations. Hadrien, can I come to you first? What are the stocks that you're recommending today?
Yeah, so the first one that we are really bearish on in the short term is a Colpal, a Colgate-Palmolive. We are seeing a consolidation breakdown after almost a week's sideways move, and I think one should capitalize on such move on Colpal because you don't get to see such breakdowns on it. So one can consider short selling Colpal June futures, play for a target of 1179 and keep a stop loss at 1224. The second stock that we are bullish on in the short term is GHCL. We are seeing a price volume breakout on the charts along with other oscillators also indicating that the positive momentum would further extend. So I think one can consider going long in GHCL, play for a target of 297 and keep a stop loss at 285.
And Jay, you continue to like Glenmark, but what else is on your list?
Well, yes, along with Glenmark, wherein I think a decent correction has been seen in a couple of trading sessions now, the stock has reversed from the 600 levels on the upside. I think at lower levels, this stock has a good support around 567 for the short term, 560 on the lower term, in the medium term. So I think Glenmark can be bought at these levels. I'm expecting again a bounce till 605 on the upside, so that's the short term call. And along with Glenmark, what I like is M&M. Now this stock has been consolidating since couple of trading sessions. Now we have seen a good move coming in the last series, and in this series, if you see that this stock has formed a good symmetrical triangle pattern on the daily charts. Now I think at the lower levels, 900 is a good level to get into this stock. So in today's trading session, if at all we see some dip coming in M&M, then 900 is the level to watch out for. One can buy it on dips around 900 with a stop loss of 880, targeting around 940.
Okay, so those are some ideas from our experts. Let's now try and talk about the Bloomberg Edge pattern. Jayesh Khilani is here to talk about what the terminal has thrown up on Nalco, Jayesh.
That's right, Neeraj. There's a sell indicator on based on the MACD indicator on Nalco, and what is interesting is that the stock has in fact declined after forming a double top in the recent few months. First, let's have a look at what the moving average convergence divergence indicator is and what are the conditions that you have to keep in mind. Now, it shows you the relationship between two moving averages, and it plots two lines: the MACD line, which is the difference between the 26-period exponential moving average and the 9-period exponential, 12-period exponential moving average, and the signal line, which is the moving average of the MACD line itself. It helps you to identify where the turning points are in a trend by crossovers, and if you have a look, you buy when the MACD line crosses above the signal line, and you sell when the MACD line crosses below the signal line. And this is what has happened on the chart of Nalco. Now that's the last 6-month chart on Nalco. These are the two double tops that I was referring to, which is in the zone of about 85 to 90 rupees per share, currently trading at about 69 rupees. That's where we have seen the entire decline come about. There could be further weakness based on the MACD indicator, which is the bottom panel, and you can see that the blue line has in fact dipped below the white line, and all of this has happened below the reference line of 0. So a strong sell signal coming in as far as Nalco is concerned.
And how would you decide on the success rate based on historical evidence, Jayesh?
So Agam, I backtested this, and all the sell indications in the last 1 year would have resulted in a profit of about 16 to 17%.
Oh, that's interesting. Thanks a lot for that. Metals are firmly in focus. over the last few days, and today would be no different as well. I think, unless I'm very wrong, the metal index has corrected for each of the last 7 days. So no surprise there that the pressure continues. Adrian, since we are on the metal subject, just a quick check here. You haven't given metal ideas today, and which is why I'm asking this question to you. What about SAIL or what about Vedanta, which are looking under some bit of pressure? Has the trade played out already, or could there be more in store?
No, I think there is more in store for the metals because if you see the overall metal index, it's trading in a triangle, and there is still scope for some downside before it hits the lower end of the overall triangle. So I think Hindalco is a stock that's looking, ready to go down even further. We are seeing negative crossovers. Very important. It has broken the long-term 200-day moving average. So I think if anybody is considering a trade in among the metal stocks, I think Hindalco would be the one that one can consider short selling in the June futures.
Okay, let me extend that question to Mayuresh as well. Mayuresh, how would you approach something like a Hindalco or Vedanta now, considering there's been so much weakness coming in through for some of these stocks?
No, again, I think a large element in what can transpire because of the trade wars are clearly getting displayed in terms of the commodity stocks. Couple that up with some recent data points that we've got in terms of the inventory building up in the Chinese markets and the retail demand probably being a little bit weak. I think you've probably seen realizations come off on the LME, both for the ferrous as well as the non-ferrous pack. But for the domestic players, I think we've got a strong domestic presence. My own sense is that the demand is probably holding up pretty strong. What you probably witnessed in terms of input prices actually moving up, both iron ore, coking coal, for example, I think there has been some cool off being witnessed on that front. But the volume activity has been very, very resilient. And to that bit, again, I think the realizations, in fact, have remained very, very strong. So I think it's a volume story specifically for the domestic players. Expectations of volume remaining strong and EBITDA per ton probably holding up should give the necessary leverage on their balance sheets. So I think JSW steel still remains a very clear hold for us. Josh was mentioning NALCO because of all these issues and concerns surrounding aluminium prices, probable depletion in the prices of alumina as well, which is probably the cash cow for NALCO. You might see some correction happening, but I'll wait for probably a couple of months in terms of how data points are moving out. And with the stock correct significantly, I think that also can become a very good buying opportunity. But I think you need to wait for data points over the next few weeks.
Mayuresh, the footwear stocks were active yesterday. I saw Angel Brokings turn bullish on that back as well. What's the sense here? I mean, and would you like the space across the board, or do you have a specific preference for Bata?
We'll be very specific here, Neeraj. And again, I think if you look at the dynamics for the industry, you're probably looking at far more traction happening for the organized players. Having said that, again, I think the kind of dynamics that Bata has posted in the year gone by, gross margins improved to 54.5%. You probably had an expansion in EBITDA margins to 13.6%, both in terms of the product mix and the cost optimization. The rental costs have probably plateaued off at around 13.5, 13.6%, with far more rationalization happening in terms of store sizes. And to that bit, again, I think the kind of earnings growth that we probably expect, 17-18% on the top line, 19-20% on the bottom line, looks very, very feasible. The balance sheet itself has 588 crores of cash as on March 31, 2018. And what you're probably looking at, even in terms of return on capital employed at 20%, I think there is significant scope of expansion because the product mix is changing for the better. You might have seen the recent ads of Bata, and a lot more emphasis has been put into ladies' footwear. You're seeing the Bubble Gummer brand for kids probably also gaining a lot of traction. And to that bit, again, I think that product mix will support and abet earnings growth as well. Relax, on the other hand, also looks very, very interesting because the kind of moves that they have delivered in the past in terms of a 15% top-line growth, 20% EBITDA growth, 28% bottom-line growth, ROCs in excess of 25%, ROEs in excess of 20%, not significant debt on their balance sheet as well. I think footwear stocks probably are feeling a lot more better at this point of time, and we probably remain a lot more sanguine on this sector over the medium term.
All right, well, we just have a little more than a minute left for pre-open, so I'm going to take the question on Dr. Reddy's with Jay. Jay, I know that you've been comprehensively been talking about some of these pharma sector names. Dr. Reddy's is one stock which has disregarded its fundamentals and still moved up yesterday. How are you viewing trade on this one?
Well, see, usually what happens is, despite of having negative news, if the stock doesn't fall, and if the stock is in fact reversed from the lower end, that clearly indicates that overall bias is up, and any sort of negative news, if there is at all related to that particular stock, and if that is utilized or that is getting absorbed at the lower end, means there is a lot of short covering happening in this stock, and there is still a lot to happen. So traders who are already short in this stock are in fact wanting the stock to come down so that they can at least cover or minimize their loss if at all they are short. So I think that Dr. Reddy's on the upside has the resistance right at the levels of 2620 levels, and it's still quite far away from those levels. I think yesterday's close was somewhere around the levels of 2385, 2400 levels approximately. So we can see another 10% move coming on Dr. Reddy's from these levels as well.
Okay.
So if someone is holding long in this series, continue to do so. If at all there is a dip, don't worry about it.
Okay, hold that thought, Jay. We just addressed the pre-open rates and as expected, we are looking at a downtake on the Nifty 50. Not a substantial one. Actually, we're seeing mixed moves coming in, so we're going to wait for some of these prices to settle down. The Sensex, of course, is indicating an up move around 0.3%. Let's bring up ICICI Bank because that is potentially perhaps the biggest stock that which will be in focus. We did see a lot of strength in ICICI Bank yesterday, but it is indicating a decline of around 1% for now. Perhaps about a profit taking. It's going to have to be a wait and watch on this one. Let's bring up the OMCs then as well, which also were quite strong in yesterday's day of trade. BPCL trending downwards by as much as 1%. HPCL as well down by as much as 1%. Let's take a look at Indian Oil Corp. That's marginally in the red, so rather flattish. Metal stocks didn't do well yesterday. Vedanta and Hindalco were under pressure. Hindalco down by as much as 0.4%, and Vedanta also seeing about a 0.5% cut in pre-open rates. And let's also bring in some of these pharma counters which were also doing well yesterday. Dr. Reddy's is one of them, which did disregard the news that the US had a restraining order on Suboxone. It did move up in the last half an hour of trade. For now, flat. And let's pull in Lupin as well as Sun Pharma as well and see what's happening with some of these stocks which were extremely strong over the previous 1 week or so. As you can see, marginal moves coming in through, not too much to speak for in today's day of trade. But as far as the major indices go, Neeraj, they're currently trading flat, with Nifty actually advancing by as much as 0.3%, surprising.
Yeah, well, I think the stock in focus remains ICICI Bank. Agam highlighted it already, but just bring that up once again. For the benefit of our viewers, after a smart run yesterday in today's session, at least the start seems to be suggesting a bit of a pullback. Let's wait and watch. What's down and out and continues to remain low is 1% beverages. That's down another 5% at least in the first tick. Let's wait and watch if that lasts or no. Sugar has come off or cooled off completely from that spurt that it showed some time back, but I'm interested in seeing what the OMCs and the oil and gas refineries would be doing. So BP, HPIC, big moves yesterday, maybe a bit of a cool off. Chennai Petro has this unnatural uptick, 6% higher. Let's wait and watch if that lasts or no. Yeah, it has cooled off a little bit as well again, but nevertheless in the green. Let's wait and watch if it corrects further. And Agam was speaking about Dr. Reddy's. Well, bring that up again. It's very, very volatile, so let's hold on to our horses. Here I don't want to comment on whether this will last or no, but it's extremely choppy out there for Dr. Reddy's for sure. Let's wait and watch what happens there. Last but not the least, the footwear companies were very active in trade yesterday. So Bata, Liberty Shoes, etc. will come up on your screen. 5% up for Bata yesterday, another 1%. Relaxo is flat, but Liberty Shoes, which was up about 17% if I'm not wrong in close, up another 5% in the first couple of minutes. Let's wait and watch if this lasts or no. Last but not the least, the rupee as well as the bond yield should come up on your screen. Remember, the bond market started off slightly better yesterday. Let's see what's happened today. The currency at 68, some bit of strengthening overnight and right now flat. And the bond yields will come up on your screen. 7.87, no, nothing, just about flattish, and in fact gave off some of the gains in trade. Give a pullback in trade yesterday as well, did the bond yields. However, before we move any further, Sumit Sarkar Johnson with the big brokerage calls for the day. Sumit, good morning.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is Phillip Capital on Kotak Mahindra Bank. Now, the brokerage has initiated coverage on this bank with a buy rating and a target price of 1,545. Now, according to the brokerage bank's digital strategy of 811 has been an early success with nearly 60% growth in its total customer base. Now, Kotak Bank is well positioned to capture loan market share, and the rising interest rate environment bodes well for the bank because it has a high proportion of low cost deposits, says the brokerage. Now, Phillip Capital is expecting the bank's net interest margin to expand by nearly 19 basis points over FY19 to FY21, and is also expecting the loan growth momentum to continue with a compounded annual growth rate of around 22% over the next 3 years. On the asset quality side, it says that the bank has one of the best asset quality in the industry and it sees no downside on this front. Lastly, it is expecting the bank's earnings to grow at a compounded annual growth rate of 28% over FY19 to FY21, which should result into a 2 times return on asset for the bank by FY21. Second, we have is Motilal Oswal on Maruti Suzuki. Now, the brokerage has maintained its buy rating on the stock with a target price of 10,525. Now, the brokerage says that there is a negligible impact of higher fuel prices on the domestic passenger vehicle industry. And for Maruti Suzuki, its alternative fuel portfolio will benefit from this higher fuel prices as the company has the widest range of CNG portfolio in the industry. It also says that the inflation in the raw material prices are being managed by the company by cutting its cost and by taking hike in prices. Lastly, it is expecting Maruti's margins to expand by around 200 basis points on the back of lower royalty, ramp up of Gujarat plant, improvement in sales mix and discount reduction.
Sumit, thanks for joining us and giving us those details. We'll be watching out for some of those broking calls for the day. But with that, let's address what's happening with TCS. Now, if you consider the way the Nifty has moved over the last 1 week, it's largely flattish. And by last 1 week, I mean the last 5 trading sessions. However, TCS is one of the reasons where the Nifty is marginally in the green through the course of the last five days. TCS is up as much as 4.5% in the same period. Hadrien, I'd like to take up TCS with you, considering all the fundamental news with respect to the buyback coming through. If you keep that aside, how are you viewing trade on Tata Consultancy Services on a technical basis?
Yeah, it's absolutely screamer of a stock. The stock has been in a very, very solid uptrend. If you see the previous trend is also pretty strong. It continues to maintain its high top, high bottom structure. I think the strategy in TCS has to be every decline has to be an opportunity to accumulate a TCS. So without a doubt, any fall if you get in TCS should be used to accumulate.
Interesting. Yesterday's session also showed some optics for Vakrangi Software. Let's see if that lasts. For now, it's looking like that. But the man of the match might well turn out to be ICICI Bank yet again. 299 now as the pre-open rates are coming to a close. ICICI Bank seems to be showing some strength, about a couple of percentage points after a 3.5% up move in trade yesterday. I know a bunch of viewers have tuned in right now, and we'll ask this question again to both our technical and fundamental experts for their benefit. But firstly, a chart check out here. Thakkar, for somebody who is long on ICICI Bank, what are the immediate targets?
Well, I would say that on the upside, the immediate target comes to the levels of 303. It really needs to take off those levels in order to surpass this previous swing high of 320. So I would say if it is not able to surpass 303, not able to sustain about those levels, then book profit at those levels if you're already long. And someone, if in today's trading session would like to build up fresh long positions and for the positional or short-term basis, then I would say is the level to watch out for 303. If it even if it closes an hour on the closes above those levels on the hourly charts, I think it's a buy for the target of 320.
Mayuresh, what about somebody who was contemplating whether or not to buy ICICI Bank and stayed back because of all of these things that have happened? Now that they are seeing some sorting out, would you go out and recommend that ICICI Bank could be one of those corporate-facing banks that can be bought into?
Oh yes, and to be bought into in a staggered way, very clearly, with the transition probably taking place. I think the overhang, at least from a medium-term perspective, till the probe probably gets over, is out of the way. And as one of your analysts rightfully mentioned, I think the focus comes back to core fundamentals. As I discussed earlier on the show, the fundamentals are showing significant signs of improvement, and they will exhibit far greater growth, both in terms of retail advances and probably recognition of their asset quality, which has largely been done. Again, valuations probably very, very supportive for the bank at this point of time. So I think all the factors probably working in favor of ICICI Bank at this point of time. So yes, I think in a staggered way on declines is the way I'll probably look at accumulating the stock.
Reliance Industries is the other one, which has been relatively strong in comparison to some of the other Nifty counters. Currently at about 1,013 on your screen there, looking at a marginal decline. Hadrien, what kind of technical cues are you picking up from Reliance Industries in terms of levels to watch?
And Hadrien, if I can add on to that question, there is a viewer query that has come in. The gentleman has bought a Reliance 1020 put option at 22.50. He's asking whether he should hold or quit.
No, I think first of all, Reliance Industries is in a really strong, uptrend. Secondly, the consolidation that we have seen in the past 8 to 9 weeks, the stock is on the verge of a breakout from those levels. In fact, it has already broken out in the previous week. So I think the trader who is actually holding a put option should consider exiting from there, because I think I'm seeing a breakout that may take Reliance Industries above the 1050 levels on a very conservative projections that I am putting onto on Reliance. So I think being long is much more fruitful rather than going short.
Interesting. Okay. Actually, we say the question on Delta Corp. It's been a stock which is active as well. We'll ask Mayuresh Joshi about it. But Sunil Charles, stay on. We'll ask your question for sure. It's something that I want to know as well. But just since you're minutes away from market open, let's tell you all that you need to know to stay ahead in trade today first. Good news for shareholders of Borosil Glass Works as the company's board approves a 3:1 bonus issue. The stock locked on a 20% upper circuit.
And labor issues cause a temporary halt at Goa Carbon's operating unit in Paradip.
And ICICI Bank's board meeting concluded that CEO Chanda Kochar will go on leave till the inquiry against her is completed. Sandeep Bakhshi is named as the new CEO, will report to the board. The stock likely to start off 1% higher.
In Glenmark Pharma's manufacturing facility in Monroe, North Carolina gets the first supplemental abbreviated new drug application in the US FDA approval. The company has invested more than $100 million into the facility.
In brokerage calls, Phillip Capital initiates coverage with a buy rating on Kotak Mahindra Bank, setting a price target of 1545, commenting that the bank is well positioned to capture the loan market share.
And the government offer for the second tranche of the Bharat-22 ETF opens today for anchor investors. For non-anchor investors, the offer will be open from the 20th till the 22nd June.
Okay. So those are some stocks to watch out for. Mayuresh Joshi, have you looked at Delta Corp recently? And for somebody who's looking to buy into the gaming business, Ramesh Damani has been talking about how you should learn from global businesses, so on and so forth. Is Delta Corp that secular growth story, or is it difficult to make it, or think of it as a secular story?
Can't really say whether it's a secular growth story, but what probably transpired post demonetization and the kind of fall that we probably saw in terms of jitters getting played out, on terms of how volumes would probably pan out. I think the normalization probably happened a few quarters down the line. Now, with all the changes that have probably been happening within the industry itself, with a lot of taxes expected to come in, and because of this regulatory overhaul, you're probably going to see a lot of the players who are probably offshore at this point of time. And Delta also has its offshore units probably getting affected. But if you draw assumptions and you probably have some amount of expectations in terms of either most of these businesses shutting down, including Delta's offshore business, if that is an extreme possibility because of the increase in taxes that you've probably been witnessing, you're probably going to see some share probably happening towards this onshore business. So large element in terms of whether earnings can get detrimentally hit. My own sense is that it probably does get offset, because I think the competition probably also shuts down. And to that bit, again, the footfalls in terms of their onshore business actually starts improving far better. What happens with regulatory changes overall probably remains a key overhang for that stock. So there are a lot of ifs and buts needed. So I think would call that the necessary secular story. But again, I think if one really draws conclusions in terms of what can actually start going through, I think the numbers probably will still remain extremely strong in terms of both footfalls as well as the kind of earnings expectations that one has from the stock.
Okay, Mayuresh, we'll leave it at that. Thanks for joining us and giving us your views on the market. So we'll continue to watch out for some of those cues. But with that, I'm going to shift focus to some of these banks. We do have Axis Bank, which is likely to open in the green. And let's get a technical chart check going in. Currently at around 525, if I'm not mistaken. That's on BSE, on the NSE, but possibly at around 522, marginally in the red. Jay, how are you viewing trade on something like an Axis Bank right now?
See, Axis Bank is clearly broken down from a symmetrical triangle pattern that's been formed on the daily charts, and I think the way the stock, in fact, reversed from the trendline resistance of the triangular pattern, I think the stock is still heading lower, and on the lower side, the immediate target comes to 502, and below those levels, we can see 495 as well. So, Axis Bank, according to me, is in a clear downtrend, and the momentum indicator is also in a sell mode.
All right, so then we just have about 40 seconds left. I'm going to top picks. Hey, Jay, coming back to you, your top pick in 10 seconds.
It's Glenmark for a target of 605 with a stop loss of 567.
Hadrien, how about you? What are you betting on? What's your top pick today?
So I'm going with a very exceptional one, and that's MRPL. We've seen a doji pattern with a high amount of volume that we have seen in yesterday's trade. I think if the doji has to work out, we're going to see a good up move in MRPL in the coming days.
Well, Hadrien, as well as Jay Thakkar, gentlemen, thank you so much for joining in today and giving us your thoughts. Really appreciate your time. This is what the markets are doing on open today, starting off marginally lower, not as bad as the SGX Nifty was indicating, but the last few days the SGX Nifty is not indicated exactly to the T, but about 1/3% lower. Not so much for the Nifty Bank though. Maybe ICICI Bank is supporting. We'll try and find that out in moments from now. The mid caps and the small caps should come up on your screen, and the mid caps have started off on a weak footing. Typically the small cap index starts off flat and then tends to succumb to more selling, and typically ending up as the worst performing index on a day when the markets are soft. Let's wait and watch if that happens today. The heat map should come up on your screen. More red than green, no surprise there. OMCs take a bit of a backseat today, so after a big move, HPBP, IOC are down today. Vedanta continues to grind lower. The metals are clearly in a sorry state the last few days. Coal India continues to grind lower as well, and hardly any gainers. No, ICICI Bank is not supporting. In fact, it's not even in the green. I don't see ICICI Bank there. In fact, I don't see ICICI Bank anywhere in the top losers list, or the best performing stocks or the slightly lower performing stocks. Okay, right here, 0.5% lower for ICICI Bank. So that notwithstanding, we don't have too many gainers. Hardly any gainers, in fact, except for Dr. Reddy's, which is marginally higher, and HCL Tech, which is marginally higher. But a list of losers and a string of losers out here. Commodity names, OMCs continue to grind lower. Just bring up ICICI Bank for the benefit of our viewers. That's the stock in focus, and just want to highlight that once separately as well. About 1/3% lower. So after a big move yesterday, correcting a bit today. Remember, our technical experts said that, at least to their view, for the stock to continue in its momentum, it needs to take out 304 or thereabouts before it can move up further. Suffice to say, at least in the first few minutes, it doesn't look like it will take out those levels. Maybe buy the rumor, sell the news, working out here in ICICI Bank. The markets, though, very, very flat right now. Agam, what are you spotting?
Well, not very big moves when it comes to the broader markets. I'm going to address some of these gainers today. We have Vakrangi, which is once again locked in an upper circuit of around 5%. But UCO Bank along with Dena Bank from the public sector space, both of these stocks advancing by as much as 3%. And we have JBF Industries as well, last week's loser, advancing and building on the kind of gains that we saw yesterday as well. Gati is one of the other counters which is doing well in today's job trade. On the losing end, we do have weakness in CG Power, and that continues to lose out actually. That's down and out for now, at least. And 1% beverages, of course, declining by as much as 4%. So volatility continues to come into one of those. And Indiabulls Ventures, of course, the other one, down by as much as 3.3%. Phoenix Mills and DCM Shriram, each of these stocks also down by as much as 3%. So on the whole, we're looking at, well, declines, but not substantial ones, and the momentum is fairly evenly poised between the gainers and the losers.
Well, let's talk about somebody who's managing his schemes very, very well for the benefit of his investors, of course, in these turbulent times. Jinesh Gopani, head of equities at Axis Mutual Fund, joins us right now on the show. Jinesh, good having you. Thanks so much for taking the time out. And you know, it's commendable to see Mutual fund schemes from the Axis House doing very well in such turbulent times as well. Surely you've gotten the mix right, and which is something that we will come to a bit later on. But let's just start off with what are you doing currently? If with the kind of money that is coming in, are you having enough confidence to deploy the cash into pockets which will grow? Because the markets seem a bit skittish. If there was crude troubling the markets about 15 days back, now the trade war fears are impacting the market mood at least, and who knows what's next.
Yeah, hi. So I think the money is coming thick and fast, and we are deploying it slowly. There are pockets of opportunity, and if you really see on the bottom-up stock picking and the momentum at the micro India is pretty good. So earnings momentum is good in some of the companies, and that is where we are putting more money into. So I think it is slow in terms of investments. We are waiting and watching. Especially on the mid and the small side, because there is a good opportunity if those stocks correct by another 5-10%, what we like. And on the large cap, on the blue chip side, I think there is a good opportunity in few of the stories to continue to participate, given the earnings momentum, which has been better than the expectation.
Jinesh, would you reckon that investment into companies, valuable as they may be right now, might yield results in a year which promises to be at best volatile, at worst with some bit of downside as well? I mean, we haven't even gotten into that election frenzy as yet, which will surely bring volatility back in a meaningful way towards the end of the calendar.
So I think this year it will be more of companies doing well where earnings momentum is good. CY 2017 you saw it was more of momentum play. All beta stocks, all mid caps, all small caps were going up, somewhere because of hope, somewhere there was a new story coming back, and there was good earnings momentum coming back. However, after February you saw the stories where there was only hope have got crashed by 30 to 60% depending on the sectors where they are. And also the corporate governance issue which has come out due to some of the companies where you saw auditors resign has again sort of put brakes on a mid cap and a small cap play, because the concerns at that side of the market is very, very high in terms of how the accounting is done. So again, the case in point is quality always delivers over a longer period of time. And generally, as a philosophy, we have been harping on that for last 8.5 years of our existence. And I think that is what has helped us to hold on to these portfolios and the companies where we invest. So despite having slightly higher valuation, I would guess in this market where there is so much volatility around, it is better to be in good names, good blue chip names, good mid caps, rather than go into high beta stories where there could be a possibility of bigger correction from here on as well.
Right, Jinesh, good morning. This is Agam here. You know, there are some concerns with respect to inflation, and some may argue that well, the rate hike that we saw recently may not be the only one this year. How are you building in on, and what is your view on the rate trajectory, and how would you place your bets in the equity markets based on your anticipation?
See, I think there are many factors which will decide that. First is the oil prices, and hence the currency devaluation which you are seeing, and its impact on the inflation side. I think imported inflation is not good for us. You are back to the times of 2013 where trade deficit levels were at the levels where we are now, and oil prices are also not helping us in terms of fiscal deficit or the trade deficit side. So I think to that extent we have to be watchful. The GSEC market is already telling you that rates are on a higher side. The cost of borrowing has gone up now, and our expectation, at least from our debt side, is maybe one more hike, and then it depends on how the inflation numbers pan out.
All right, Jinesh. So my question then comes down to banking. How are you allocating money when it comes to the private sector banks? What are those factors that you decide that you want to allocate more money to a certain bank in comparison to less in another private sector bank?
See, I think the most important metric for a bank is to see how they have been able to manage the asset quality over different business cycles. And that speaks about the ability of the management to understand the cycles pretty well and execute or pull back very fast if required. So even if let's say the growth comes off from 25 to 20%, but there is a scare of that asset quality might go for a big change, it is better to pull back rather than keep on growing at an exponential pace and then get bogged down by the asset quality issues. I think the biggest metric is to see how the management or the teams have been able to manage this business. See, lending is the most easiest job. Out of 10 people, 9 would be the borrowers. So it is better to be choosy to lend it to only 3 or 4 people where you feel that your money will be coming back. So I think asset quality is paramount for our selection of the stories, and the kind of stocks we are owning. We are very, very happy with the managements who have been able to manage these cycles pretty well.
Right, Jinesh, and what's the best way to play the NBFC space? Would it be microfinance, would it be housing finance, or any other way which can get you more value?
I think a bit of all, I would say, but I think it is better to pick and choose leaders in that space rather than having a basket of 5-10 stocks. So we need to do our due diligence in a better way. And again, as I said, even in that, you need to see how they've been able to manage the asset quality of the portfolio over a period of last 3, 5, 7, 10 years. And if they understand the business cycles well, they will use the capital more diligently rather than showing growth only. So I think you have to be very choosy on that. We are playing more of very affordable housing finance space. We are playing more of a B2C kind of a retail led NBFC and a very, very niche CV cycle player and one microfinance. So as I said, be with the leader if you want to be leader.
Interesting. Jinesh, while the tilt may be towards the large caps, as you said in your opening comments, but there are enough and more broader market stories which are performing. What do you think will continue to do well? I mean, for all the premium valuations that people will give into consumer durable companies, the erratic weather has put paid to some hopes for the current calendar. FMCG companies, Agam was talking about in the morning, might have some pressures of input costs going up as well. What will do well in the remainder of calendar year 18? Where do you think the earnings momentum is likely to sustain from the non-Nifty, maybe the non-Nifty 100 space as well?
Okay. So I think wherever the company has a pricing power in the business model should continue to do well. So be it FMCG or be it NBFC or be it auto sector, I think wherever the company which has a pricing power and is able to pass on its cost pretty well, I think then there should not be a big problem. Inflation generally is good for the companies because they can take price hikes if they are able to, as I said, if they have a pricing power in their product, and that adds to your value growth. Last 1.5 years, it was more of a deflation where the growths were coming only from a volume growth. Now with, let's say, 2, 3, 4% price increases also, that will add to your revenue growth number along with the volume growth. So companies who have pricing power and is able to push his product well with price increases, I think that is where your money should be invested.
Okay. Now, okay, so let me rephrase my question. Minus financials, where do you think there is some sustainable pricing power, not just for the next calendar, but say if it's possible to predict that, and if you're factoring it in your Excels, where do you believe pricing power is likely to stay as consistent as it can for the next 24 odd months?
So I think some bit of auto sector consumption, many of the players have the product where they have almost 60-70% market share, where they can take price hikes. I would not say easily, but at least they can do it in a staged manner. So I think some bit of consumption, some bit of auto. So non-financial, if you ask me, these are the spaces where I think there is a good ability of the companies to take the price hikes and grow your revenues for next 2-3 years.
Jinesh, what's helped you perform so well in calendar year 18 compared to the others? I mean, has there been either an allocation strategy or an exposure strategy which you've taken which is vastly different from the rest of the street?
So I think one thing which has helped out to us, and which as I said, we harp on our philosophy, is the corporate governance. It is relative corporate governance.
But Jinesh, I would believe
the quality of the management.
But Jinesh, I would believe Jinesh, allow me to interrupt.
Sorry.
I would believe a lot of your peers would be doing that as well. They're just kind of trying to take or stick to quality companies. Surely there is something that has happened wherein your exposure or your allocation helped you combat the headwinds better than the others.
So to be frank, we have been holding on these stories for now many years now. You see any of our top 10 picks in our portfolio, it is not that we have changed it in February or January to make returns out of it. Obviously, I would say IT as a sector and one of our top pick has helped us significantly, because luckily we had started invested in the technology pack 6 to 7 months back, slowly and steadily. And now it is one of the top 3 picks in most of our portfolios. So that has helped us doing very well. Rest is frankly, Neeraj, wherever there has been good earning story and the quality of the management is paramount. I think that has held on very well, I would say. So the portfolios have held on very well in the massacre, which you saw from Feb to May. And I think that is what has helped us to just hold on as better as possible.
Okay, Jinesh, we'll leave it at that. It was a pleasure speaking with you. Thanks for joining us and giving us your views on the markets. But with that, we'll slip into a short break. But coming up, we discuss RBI's Vision 2020 with Executive Director Rajeev Ahuja. And CCR Products wants to take its coffee strong rather than light. Managing Director Challa Srishant will tell us more on the other side of the break. Stay tuned in.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution hai. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई, हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge. साथ हमारा, सफलता आपकी. the SME Growth platform from India's largest stock exchange.
One more opportunity to invest in ICICI Prudential Mutual Funds Bharat-22 ETF and own jewels of corporate India. From 6 core sectors at a discount of 2.5%. The scheme seeks to give you growth, stability and create long-term wealth. Non-demat account holders can now invest in the new fund offer of ICICI Prudential Bharat-22 FOF. Hurry, invest in the scheme of your choice. Further fund offer and NFO closed 22nd June 2018. To invest, visit ICICIPruMF.com. Tarakki kare. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Catching up on news feels like a test match. Want the highlights? We hear you.
It's an ocean of news out there. Need a navigator? We hear you. Do you have analysis paralysis? A case of too much information and not enough time? Do you wish someone would just pick the most relevant topics and tell you what you need to know? We hear you.
Good morning. You're watching Bloomberg Quint. This is First Word.
Curated and presented by Bloomberg Quint's senior-most editors. Weekdays at 8 a.m.
Welcome back to Indian Open right here on Bloomberg Quint. You know, a few days ago, I put out a personal tweet about how some of the men who are heading financial institutions in the country are all talking about being set for growth for the next 5, 7, 10 years. Uday Kotak recently in the presentation mentioned that there is an opportunity to sustainably grow at 2x the nominal GDP growth. Rashesh Shah in an interaction to us told us that they can grow at 3x to 5x growth in all key businesses by 2025. Equities, a small name, 30% CAGR for the next 5 years. RBL Bank has set a tall targets for itself as well. According to the Vision 2020 put out by the private lender, it's pricing in a 30-35% compounded loan growth. It also wants to improve its CASA ratio by a percentage point each year and aims at a cost-to-income ratio of 51%, which is lower than what it was, what it is currently. How does the bank plan to achieve all of this? What's the big picture story, not just from a 3-year perspective, but maybe from slightly ahead as well? And how would macros impact all of this? Let's find that out from Rajeev Ahuja. He's Executive Director at RBL Bank, joins us right now on the show. Mr. Ahuja, good having you. Thanks so much for joining in.
Thanks.
First off, the bat, this vision, while to many people might sound ambitious, is it, to your mind, par for the course because of the growth that we're seeing in financial services and how everyone who's doing a few right things might be able to do this any which ways?
So, yeah, I think you've answered your own question.
Have I? Okay.
Yeah. So, in our organization, we first say build it right. So, I think you mentioned about are you set right? And I think you mentioned, Mr. Kotak, that are you prepared? And I think we've been preparing for this since the time we came into RBL. And obviously, on a day-to-day basis, you keep blocking and tackling. But on a long-term perspective, I think businesses are improving. Businesses are growing. We've grown, you know, close to 40-45% compounded, maybe more in the last 7 years. I think there's an opportunity for us to at least grow 30 to 35% is what we have laid out. And that growth is predicated on having a very strong set of principles, practices, and a foundation, capital structure, governance, risk management. I mean, if you don't get that right, the growth does not matter. So what we labored on for the first several years is to get those right. You know, how we do our business, how we run our processes, how we do risk management, early warning systems, what do you stay away from, what can you digest and what you can't. And knowing fully well that India is not a 1 year, 2 year story. It's a secular story over 10, 20, 30 years. I mean, if I take you back to early 90s when the first set of private sector banks came, everybody wondered why were these banks going to succeed when you have a very dominant state-owned banking system, all private sector banks and the foreign banks. So actually for most of 90s, the foreign banks were really the kings of the hill, so to speak. But these banks have grown, but not all banks have grown actually the early 90s, because some of them got merged because they could not adapt to the changing times and risk management. So to me, every 5-10 years will bring more and more opportunities. And I think we are in a fairly interesting time, and the way we see it that, changing consumer and business behavior, some aspects of the government infrastructure policies. So for instance, a payment infrastructure predicated on NPCI, UPI, IMPS did not exist 5-6 years ago. Aadhaar, the identity structure, defined benefits, did not exist 5 years ago. GST has just about started. Okay, I think 3 years from now, you'll figure out actually GST was a big game changer for us because it brought a lot of data access. On the flip side, a lot of small businesses who do not have the luxury of having large finance teams, very well organized, internal structures, can now actually get more formal access to finance. Now, these are the things which are new for this era. So I think you have to grow. Growth is there, but underlying that growth is this very strong platform thinking, very strong process thinking. And I think in today's time, you have to be very adaptive to a very fast pace and very fast change, which is happening in there. We typically now leapfrog much faster than we used to.
Sure.
And that's being conditioned by public architectures, changing consumer profile, and non-traditional competition.
Right, but so this is something that will work for a lot of your peers as well, right? My question then therefore would be, what is it that will separate RBL? Or is your vision 2020 in line with what the broad growth that the economy is showing as well? Or will RBL do a few things differently?
No, so obviously we're not going to be able to recreate the same magic of the generation 1 private sector banks and the generation 2 private sector banks, Kotak being one of them. We have to chart out our own approach, which may be a few things of what really worked well then and a few new things. So internally, you guys only see the outside financials, growth, etc. Internally, how we are architected is quite different from the way the successful banks of 90s and early 2000s are architected. Has to be. It's like your business. I mean, as a media business, I mean, 10 years ago, would you have bothered about OTT, the net as much as you do today?
Sure.
I mean, today, a viewer is a journalist for you, okay? And I think those are the changing paradigms we have to contend with. Yes, every era, every 3 years, 4 years will condition you differently. And I think we have to be adaptive to that. So to me, the challenge is having that agility and adaptiveness, even as you have a very strong secular growth environment. Demand is not the issue. I think demand is never the issue. It is the quality of supply, the quality of institutionalization, the quality of your infrastructure, and how do you keep it agile? 10, 15 years ago, you did not need to be doing more than one thing right. Today, you need to get a combination of things right. So we don't typically look at competition. I mean, competition is there. We have to assume a customer has choice, which is the great part. The empowerment is moved from the supplier to the consumer. So how do you serve the consumer better and better? Yeah, you'll not win every day, but can you improve your winning chances? And your winning chances improve by practicing consistently.
Yeah, but I mean, the point that I was trying to get at, Mr. Ahuja, is not that one will win at the expense of other. I would believe that arguably with the growing economy, almost everybody who's doing a few things right will win. So therefore, my part 2 of my question is the debate around growth a non-starter of sorts, that almost everybody will, if they do a few things right, grow at 30-35%. The question mark would be that how can you grow at 30-35%? Would you be able to grow at 30-35%, keeping asset quality in check, keeping the profile of the loan portfolios such that your net interest margins can expand meaningfully from where they are right now? Are all of these possibilities?
Yeah, so look, I mean, I don't mean to say that everybody can grow 30-35%. I mean, I think profit pools will keep shifting much more rapidly. I think that's a big change from last 20 years. But just let's look at the last 6-7 years of our history. Market probably has grown between 8 and 12%, the banking market. We've grown an average of 40-45. I'm sure there are other companies which have grown similarly. Our GNPA ratio has been hovering between 1.4 and 1%. That's been the range. In fact, last year, because of microfinance, our GNPA went up, but it's coming down again now. So we've kept a very strong credit quality and risk management. And that goes back to the stuff I was talking about. How are you prepared? How are you set up? Are you built right? What are your practices, governance, platforms, people? To me, if you don't get that right, growth does not matter. And if you get those right, you get growth, and then you have an optionality of the environment changing. This year versus last year is going to be a higher growth environment for the macro as well as for the banking sector or financial services sector. But if you're not set right for it, it doesn't help you. 3 years from now, we could be doing a lot of stuff around small business finance, which will be very different from last 2 years, driven around GST data. If you're not set right for that, growth will not happen. So I think growth is going to happen because of the way you're architected. Now, I don't think everybody will get that. Maybe we'll also make mistakes along the way. So this is a very different era and environment where organizations have to not get focused on long-term planning, that I have a 10-year financial plan. It's going to be that I have a North Star, I have a guiding vision, I want to be very customer focused, but focus on my competency and be very adaptive. That will help us get to our Vision 2020 and hopefully beyond that. I don't think we can take growth for granted. I don't think we can take risk management for granted. We have to work at it every day, and sometimes it shows up, sometimes it takes a little longer. That's the only thing.
Okay, just to follow up on 2 or 3 things that you mentioned in this answer. You mentioned about how in the past few years or a few quarters, your gross NPAs, for example, have stayed in this 1 to 1.5% band.
Yeah.
You reckon that will be the case going ahead as well?
Yeah, so far I think what we see on the horizon, I think we are set fairly well from a risk management perspective. We think that specific issues around the last 2 years for us are now abated. I think generally the corporate culture and setup we have, we're not part of any of the stress sectors, so to speak. NCLT, while it's an important and it's actually a great reform for the banking industry, we're not involved in any of the top 15, 30, 40 cases. We're fairly well provisioned, I think, but we can't take it for granted. So while I'm positive, but I'm also, crossing my fingers and saying every day is a new day. Every day has to be more and more discipline, more and more practice.
No, from the point of view, the vision that you have right now, that's essentially what I was trying to drive at. Some investors who look at your stock more closely are of the opinion that maybe, just maybe, your microfinance exposure could be a tad bit lower. Now, do you believe that as well, and is there a conscious strategy to do that, or do you believe that good growth can happen with the kind of exposure that you have to the microfinance space?
So our overall microfinance, and we call it inclusive finance because it's just not microfinance, and actually that's the other thing, there's so much more happening in that segment, is a 10 to 12% overall for us. I think we'll be in the same ballpark going forward. I think we run a fairly diversified segment book. We don't think the challenges of inclusive finance, basically are commensurate with the returns of that sector. You're creating a lot more customers in this business. Over the last 5 years, we've got 2.5 million customers in this business. Now, those customers are actually not just borrowers, they're savers. The DBT subsidies coming to them, they come to our branches, BC branches, to access. We launched a very interesting, medical insurance scheme for them with our partners. They need all those things. Now, I think all of those things go into the making of a broader relationship. Yes, it is a sector, it's a segment where the volatility of cash flows and economic profile can set them back. But on a long-term basis, I think they'll come out into the formal economy more and more. And the environment around them in terms of data, the bureau, mobility, and many other economic players is going to keep uplifting them. But you have to run a fairly diversified book. There will be knocks here and there. You need to absorb them. You can't build an overall microfinance book of the entire bank, but in good proportion, you can actually sustain it. And we think the risk-adjusted returns justify it. We think we are creating customers, and we are seeing the benefit of continuously engaging them as a bank versus just as a lender.
Interesting. Okay. My final question, Mr. Ahuja, is on one, the growth is there, the return ratios will pick up, asset quality will be contained. What about costs? Will this come at a higher cost, or would the portfolio mix ensure that your NIMs, for example, move up because you are more retail than what you are currently? Could you share some numbers?
So, as you said, this is a 3 to 5 year outlook. And I think if you go 3 to 5 years back, March 14, we had a cost income of 72%. March 16, we were just under 60%.
60, yeah.
We've ended financial year 18 at 53. So the scale is working, the economies of scale are working. And in most businesses, you need to have invested for 3-4 years before you hit the inflection point and you reach escape velocity. I think in all our businesses, which are heavy upfront investing, we have reached or about to reach escape velocity. So you'll see us improving our ROAs, which is one component is the cost income. In NIMS, again, if you go back 3 or 4 years, we were 3 or under. Today, we are almost touching 4 in the Q4 of last year. And we've guided that we will be 4+, even as cost of funds pressures are there in the economy. It's because of the variety of businesses we sustain. So I think from a long-term perspective, you need to have all levers in place. Short to medium term, 1 or 2 levers play out, but cost income will keep dropping, which is a function of scale, learning curve, all of those things matter.
Great. It's great to get some insights out here, and maybe at some point of time we'll talk about what goes behind the bank as well, not just the numbers that we see. It'll be lovely to have that conversation too. But Mr. Ahuja, for today, thank you so much for
thanks for having
dropping
us.
in. No, really good having you. Thanks so much for being with us today. Well, that's RBL Bank with their thoughts on Vision 2020. Rajeev, Ahuja talking about. Well, what came out was the confidence that he has into the predictability of growth. Other things remaining constant, of course. Let's wait and watch what happens there. Okay, the other conversation today on the corporate side is from CCL Products. Remember, they manufacture and market soluble instant coffee, a market cap of about 3,700 odd crores. The case for the chat today is a fall in green coffee prices and their foray into retailing their own brands. They've now done this reasonably well in the past as well. Let's try and figure out how is that working out too. All that and more with Challa Srishant. He's the managing director of CCL Products, joins me right now on the show. Good having you. Thanks so much for taking the time out. Now, when you ended FY18, you guided towards a broad range of 10 to 20% growth in FY19. I would presume there would be some assumptions that would have gone into that. Are those assumptions changing meaningfully, or do you believe the stage is set for you to be able to do what you guided at the end of the quarter?
Well, to be frank, our analysis was based on the current capacities that we already have. A 10% growth is something that which we were already 100% sure that we could achieve. The reason why I've given a broader range of up to 20% is because we have a new plant coming online in this financial year. By the end of Q2, it should be commissioned. One area that we don't have clarity at this point in time is how long the approvals are going to take from the customers, which is why we kept that flexibility. If we do get the approvals earlier, we might be able to reach closer to 20%. If we do not, then it will be in the range of 10 to 20%.
A lot of people get confused about the impact that a fall or rise in coffee prices have on your business. I reckon from my past interactions that there is no material impact on you as a company with these, right?
Yes, that's 100% correct. In fact, we keep clarifying this each time. Our business and a business model is not a commodity-based business as most people may think it is. We supply to brands and brand owners, which is also why our model is not affected by the fluctuating green coffee prices. Prices keep fluctuating every year, and you would have noticed that our performance has been quite consistent. Our growth has been consistent year-on-year.
So, Srishant, why is it that, for example, there is a brokerage note from Edelweiss which has come out, which is saying that the falling green coffee prices, which are down about 15% YOY, are likely to impact revenue? I mean, would there be, I'm guessing that there would be an impact on revenue because the top line would go off as a result of the lower prices, but would that be as substantial impact?
Yes, it definitely will be. The revenue impact is definitely going to be there, which is why we say that the revenue growth is not the correct indicator for us. Green coffee prices have fallen by more than 15 to 20% from last year to now, which automatically means that there will be a proportionate decrease in the top line. 70% of our production cost is raw material itself. So there is a significant impact on the top line. The bottom line will give you a better indicator because our volumes are increasing. Bottom line is also increasing.
Interesting. Can I? Okay, you obviously looking forward to this retail foray of coffee. Now, tell us what are the kind of numbers that you're working with? The reason I also ask this is because, in a manner of speaking, you're a relatively new brand. We already have established brands here. We already have some global tie-ups wherein Nestle is talking about selling Starbucks coffee in a packaged fashion as well. So there is arguably serious and more competition coming in, maybe more popular competition coming in as well. In light of all of this, where would CCL fit in? Would it be a strategy of taking away some market share into areas where you have dominant distribution, or do you believe that the market is growing so well that everybody, including you, will be able to create that small niche for themselves? Well, how will this retail plan shape up?
Actually, that's a very good question. I need to give you a bigger picture analysis first to get a clear understanding about what we are doing and why we are doing it in the domestic market. First things first, a country like the US, they consume about 80,000 tons of instant coffee in a year. Japan consumes around 35,000 tons of instant coffee. All these countries are a fraction of our population. We in India, we are consuming about 10 to 15,000 tons only. India is growing at the rate of 15 to 20% year on year. Unfortunately, there has been no innovation in instant coffee for many, many years in India. Across the world, there have been a lot of innovations, new products, new product categories that have been introduced. But in India, none of these have actually taken off. Something as simple as freeze-dried coffee. Today, it's available at a very, very high price in the market because one has to import it, they have to pay duties and taxes, and then they will sell it in the market. We have manufacturing capabilities within India, which also makes it more economical for us to produce and sell in the domestic market. All these factors put together, we felt that we have the necessary strengths to introduce the right range of products in the domestic market, which is why we are not just targeting the same standard vanilla type products that are already there in the market. We will have those products as well, but our focus is going to be on new products and new product development that we feel that there's a larger potential of growth in the market. This is one of the reasons why, projections wise, also last year we had achieved about 46 crores in the domestic market. This year we're projecting about 100 crores, and based on our first quarter performance, we are more or less on track for achieving this target.
And the vision is what? Does it grow exponentially in the years ahead?
Yes, it really does.
So, I mean, exponential is what? A growth rate on this smaller base of northwards of 30, 40, 50% compounded? Is that a possibility?
50% is what we are looking at.
For the next 5-6 years?
Yes.
At least. Okay, great. My last question really, because running slightly out of time on the show, based on the capacity that comes on stream in the second quarter as well, you mentioned about what will happen to the top line, which is also a factor of prices. What about the operational metrics and what about the bottom line numbers? We haven't had a chance to discuss this post your numbers, so it would be good to get a brief on that.
This year, the bottom line will be significantly higher than what we will see in the top line because there is a fall in the green coffee prices. Bottom line, we are looking at, again, between 10 to 20%. It depends on on a number of factors, including the new plant coming online and the customers giving their approvals. So the sales would depend on these factors.
Okay. Maybe at the end of Q1, we'll be able to talk more numbers. But Challa, Srishant, it was a pleasure talking to you today. All the best with the strategy, more importantly. We look forward to having that brew someday.
Thank you.
Well, let's see CL Products with their thoughts on what the outlook ahead could be like. The markets, though, are fairly tepid currently as we wrap up this leg of Indian Open. We have about 0.4% of a dip on the Nifty. The Nifty Bank just about 0.2% as well. And ICICI Bank just need to bring that up and see what that stock is doing in the session today. Started off weak and has stayed about, well, 0.5% or lower. So no big bang reaction. Maybe buy the rumor, sell the news is what happened. OMCs too looking fairly soft. Thanks so much for watching this leg of Indian Open. Up next is the F&O Show.
Sorry.